Did you know that you can grow your money without taking big risks? Imagine having investments that don't keep you up at night worrying about the market going up and down. Today, I'm going to show you how to build a low-risk portfolio that can help you earn steady returns without unnecessary risk. But first, let's talk about what risk means when we're talking about investing and how it's measured. Risk is simply the chance that your investment won't give you the results you were hoping for. In the investment world, we usually measure risk by looking at volatility, which is how much an asset's value goes up and down over time. High-risk investments might offer bigger returns, but they can also lead to bigger losses. On the other hand, low-risk investments aim to provide stability over the long term, with moderate but consistent returns. The key to reducing risk in your portfolio is diversification. This principle allows you to spread your investments across different types of assets, sectors, and regions. By doing so, you reduce the chances of a single investment causing you big losses. This is because if one asset goes down in value, others may be going up or staying stable. For example, if you only invest in technology stocks, your portfolio could be significantly affected by the ups and downs of the technology sector. On the other hand, by diversifying into bonds, index funds, and stocks from other sectors, you achieve a more balanced portfolio that is less vulnerable to big drops. Are you diversifying your investments? What types of assets do you have your money in right now? Now, let's talk about the types of assets you can include in your low-risk portfolio. Here are some key options that will offer you stability. Government bonds. These are considered the safest because they are backed by the government. When you buy government bonds, you're lending money to the government, which usually pays interest and returns the principal amount over time. High-quality corporate bonds. These are issued by large companies with high credit ratings. While not as safe as government bonds, they are still a stable option. Index funds and low volatility. ETFs index funds follow a market index, like the S&P 500, while low volatility ETFs invest in assets of companies that are less prone to big price swings. Both are great for those looking for growth with less risk. By choosing these assets, you can build a solid foundation for your portfolio without taking on big risks. One of the most important things when investing is knowing your risk profile. Are you a conservative person who prefers safe and stable investments, or are you more aggressive and willing to take risks to get bigger returns? This risk profile is directly related to your financial goals and your stage of life. If you are young, you can afford a more aggressive portfolio because you have time to recover from possible losses. If you are close to retirement, it is better to choose a conservative portfolio to protect your money. In a conservative portfolio, for example, you could have 70% in low-risk bonds, 20% in low volatility stocks, and 10% in cash or liquid investments. Once you figure out your risk profile, it's important to make sure your portfolio is spread out correctly among different types of assets. For a conservative portfolio, the ideal setup is 70% in bonds, 20% in low volatility stocks, and 10% in cash. However, asset allocation isn't set in stone. Rebalancing is the process of adjusting your portfolio to maintain that ideal spread. For example, if your low volatility stocks grow faster than your bonds, you might need to sell some of those stocks and buy more bonds to rebalance your portfolio. Have you ever rebalanced your portfolio? How did you go about it? Your time horizon is super important when building a low-risk portfolio. If you have a long time horizon, you can keep a larger portion of your investments in bonds or more stable assets. This is because you have more time to see returns in the long run. On the other hand, if you need quick access to your money, you should choose assets with higher liquidity. Nowadays, there are tools like robo-advisors that help you build and manage your portfolio automatically. These platforms adjust your investments based on your goals, risk profile, and time horizon, which makes them perfect for those who prefer to delegate the management of their investments. Another important aspect is cost. Fees from funds or brokers can impact your long-term earnings. It's advisable to look for low-cost funds and brokers with competitive rates. A lot of investors make common mistakes when they try to build a low-risk portfolio. Some forget to rebalance their portfolio, others don't diversify enough, and some are so careful that they don't let their money grow. It's important to avoid these mistakes to make sure your money steadily grows. Remember, building a successful investment portfolio doesn't mean taking unnecessary risks. With a solid strategy, diversification, and patience, You can achieve stability and consistent returns that match your financial goals. Now that you know how to build a low-risk portfolio, I encourage you to take action. Evaluate your risk tolerance, start diversifying your investments, and make sure you're rebalancing your portfolio when you need to. If you have any questions, leave a comment below. Subscribe for more content on how to improve your personal finances.